Namaskar, this is Akhilesh Bhargava. Welcome to Tit-Bits on Business and Finance with me. Ever since India was locked down to battle COVID and thereafter during its subsequent unlocking, the recovery and revival of economic growth has been uneven, it has been uncertain, it has been patchy. The recovery differs from sector to sector, obviously, and from region to region. While the organized sector and the big industries bounce back very soon, it is the unorganized and the MSME sectors which did not, and they do continue to languish. The rich became richer, but the middle class did not, and many sadly slipped into poverty. Urban unemployment shot up, while the rural jobs did remain relatively stable, and while some sectors like FMCG and metals recovered fast, many others, particularly the contact-intensive sectors like entertainment, education, travel, transport, and hospitality, they did not. For some, economic recovery did take place, while for many others, it is not, uncertainty prevails. Much as the government wished for an across-the-board economic recovery in India, which simultaneously lifts all sectors of the economy, that has certainly not happened. Thus, depending on which sector or region of the economy you're engaged in, your view about the state of the Indian economy and about its recovery will likely be accordingly so, depending on which sector you have been operating in or where are you from. The Indian economy to us remains at the crossroads. Let us discuss three different views on the current state of the Indian economy and see what needs to be done finally in order to get durable growth. In his recent interviews, Sri Sanjeev Mehta, the newly elected president of FICCI and the chairman and managing director of Hindustan Unilever Limited, he gives his take on the state of the Indian economy in many of his recent interviews. Mr. Sanjeev Mehta says that the situation in the Indian economy today is much better than what it was earlier. He must be referring to last year when we were under a lockdown. There are many green shoots in the economy according to him, such as he says that tax collections have been robust, exports are looking good, lots of FDI have come into the country according to him. And so structurally he says that there is so much headroom for India to grow, and thus private capital expenditure would kickstart once the demand revives, in his opinion. He reiterates that the situation is much better, corporate profits are good, and therefore corporates have been deleveraged and banks have been able to enhance their capital. So Mr. Mehta says that it is a good environment where once the demand kickstarts, he sees no businessman who would be wanting to miss this sale opportunity which would come once recovery comes in. And he doesn't think that the risk appetite of the Indian businessman has gone down. All he thinks is that wait for the demand to come back, investments will come in, spending will come in, growth will come in. He then says that high inflation has impacted consumption and market volumes have gone down, especially in the rural economy. But it is likely to start easing in his perception, since it is largely because of a supply side constraints or speculation in his opinion. Rural demand still looks tepid from the market volume point of view, and there is inflation in many categories, he remarks. Further, he says that private consumption has to still reach a level where you can say that we are happy with that. In other words, they are not yet quite satisfied with the private consumption levels. He says then that the private investment cycle has to kick in. Capacity utilization in percentage terms in India is still in the 60s and the 70s. Once demand moves in, only then the capital investment cycle kicks in. We have to get into that virtuous cycle of growth where the demand is robust, the capital investment happens, more jobs are created, there is more money in the hands of the people, and investment takes place, in the opinion of the chairman of Hindustan Unilever. He further mentions that till the time private capex gets started, it is the government that would need to do its bit and keep on spending. The government should look at what it needs in order to do to fuel consumption. The first bit is that the government spending should not stop, he emphasizes again. So that was the opinion of Mr. Sanjeev Mehta on the Indian economy, the FICCI President and Chairman and Managing Director of Hindustan Unilever Limited. The other perspective on the economy comes from Dr. C. Rangarajan, former Reserve Bank Governor and former Chairman of the Prime Minister's Economic Advisory Council, an eminent economist in himself. He says that due to COVID-19, the economy has lost 2 years, one in decline and the other to cope up with the decline, and that there is a need to go back to high growth in 2022. He further says that when the economic impact is considered, there was a huge loss of output in India due to the lockdown and also due to restrictions imposed in order to contain the spread of COVID. He further mentions that while domestic demand was weak, exports grew in the first half of financial year 21-22, the current financial year, compared to the previous years. While financial markets, according to him, were expected to be adversely impacted, that did not happen, and they have continued to boom, touching new heights. Dr. Rangarajan then mentions that the government initiated both monetary and fiscal policy measures in order to help improve money supply and liquidity in the system. The monetary policy measures included reducing interest rates by the Reserve Bank, providing credit, and improving the liquidity of banks, NBFCs, and others. On the fiscal policy front, Dr. Rangarajan said that the government should expand expenditure in 3 categories. The first one, healthcare, which is expenditure for vaccines, oxygen supply, ventilators, and improving hospitals in the country. The second, for providing relief to the vulnerable poor by way of direct cash and also by way of cash relief to the poor. And the third, what he calls stimulation expenses, which is expenditure in order to support to restart businesses and credit guarantee to commercial banks in order to give further loans and credit to the MSMEs. Dr. Rangarajan then says that to achieve the growth of 9.5% projected by the IMF and by the Reserve Bank, the country needs to achieve a growth rate of 6.8% in the second half of the current financial year, which is financial year 21-22. And this comes after having grown by about 13.7% in the first half of this year. He added that in the second half, there would be no base advantage and that government expenditure is therefore warranted in a big way in order to stimulate growth. Dr. Rangarajan then says that though the growth target looks achievable, uncertainty about the new Omicron variant prevails. It is necessary to see to it that preventive measures are fully in place by the government in order to mitigate the threat from the virus and to move the economy on a higher growth path. This was the reading of the economy and the prescription by Dr. Rangarajan. The common views about the Indian economy of both these men of eminence are that though India is in a much better shape, yet domestic demand remains weak in India, private consumption is not yet at a level so as to trigger investments, and that India needs to go back to higher growth, for which the government needs to spend in order to stimulate growth. And then, as Sanjeev Mehta says, it is imperative to trigger the virtuous cycle of investment in India. The third reading of the Indian economy comes from the Economic Times in a recent report where it says that while India has bounced back strongly from the pandemic hit of financial year 21, yet a number of macroeconomic concerns that could hamper the recovery have emerged. The concerns that the Economic Times mentions which can hinder such growth include: the first one, it says, is rising inflation. With inflation, the WPI at a 12-year high, the fact is that it will obstruct growth at some point of time. It then says that the weakening rupee will aggravate the rising inflation and it will slow down growth in India. It then says as a headwind that crude oil prices have moderated, but they are expected to rise further and that will again hit growth. The concerns or the headwinds that the Economic Times mentions which can hinder growth in India include: the first one, rising inflation with WPI at a 12-year high means that it will obstruct growth. The second one, the weakening rupee will only aggravate the rising inflation and that in turn will slow down growth. The third one again has to do with inflation, which is crude oil prices have moderated, but they are expected to go further and they will fuel inflation. The fourth one, in the face of high inflation, interest rates are bound to rise. Many nations have started the process and India will also need to do that. And high interest rates are always anti-growth. The next one, the stimulus that supported revival and growth worldwide is being withdrawn, and so are the interest rate cuts, and that will ensure that growth also recedes. The next, the Omicron threat remains a key concern going ahead. Further, overall consumer demand remains soft. Till it does not turn strong, you can expect that growth will be slow. And finally, there is no capital expenditure uptrend in sight in India and unemployment remains high. Until both of them don't catch on, growth will not catch on. While these are the headwinds, the Financial Express also mentions some positive signals as the tailwinds to growth. The first one that it says is that corporate India has bounced back strongly so far and it thinks that it will continue to do so. It then further says that capital raising has been strong as seen in the record IPO inflows and that will fuel growth. It then mentions that there has been a pickup in loan growth and credit disbursal by banks showing some kind of an undertone in growth. Tax collections, its notes are buoyant and they are rising. And it finally says that there has been a smart revival in real estate in the country. To us, the measures needed to stabilize and push growth are primarily those that the government needs to initiate, which start from a stimulus and they include spending in order to stimulate growth. While we need to prevent and mitigate a third wave due to the Omicron variant, the government needs to provide, as Dr. Rangarajan says, relief to the vulnerable poor by way of direct cash transfers and stimulation expenses. We also need to provide support to restart and revive businesses in the MSME sector in particular, apart from the reforms and improvement in ease of doing business in India in order to revive investments. It is budget making time in the country. The finance minister's deliberations are on, and we hope that these words of these wise men and these perceptions will be taken into account in order to come up with measures that are needed to stimulate growth in the country. This is Akhilesh Bhargava signing off till we meet again. Namaskar.